It's also been a year of many shocks. Some are cyclical in nature. We talk about high inflation levels, monetary policy tightening. That has had an impact, but others are more structural. We talk about the longer-term effects of pandemic scarring, and some of them are situational, natural disasters, and of course, Morocco is one of them. And to add to that list, the flare-up of conflict that we've seen over the last couple of days just adds to the geopolitical dimension as well. So today we're going to be discussing the outlook for the region, the importance of reforms as well, and how the international community may see the opportunities in the region as well. A little bit of bookkeeping before I get into the panel. For those who are watching on the web link online via LinkedIn or YouTube, thank you for joining us. You can also tweet about it at #IMFMENA. So if you do want to put anything up on social media, put the hashtag up as well. But let me introduce our panelists today. A man who does not need much introduction, JIHAD AZOUR, the Middle East and Central Asia Department Head. Mr. MASOOD AHMED, the president for the Center for Global Development, and of course a good friend to the IMF family from many years ago. Mr. BISAT, the head of emerging markets fixed income from BLACKROck, and MALIK, the chief economist from Abu Dhabi Commercial Bank. Well, JIHAD, I'm going to start with you. In your report, you say that economic growth in the MENA region is expected to slow down in 2023 to 2% from 5.6% last year. Just talk us through some of the high-level takeaways from the report, from the outlook, and what the balance of risks looks like coming up.
Thank you very much, and also I would like to welcome everyone for the annual meetings and for the presentation of the outlook for the region. 2023, it's a year of transitions. We are slightly exiting the post-COVID era, whereby the various measures and the recovery that we saw in 2021 and 2022 is gradually receding. Of course, we are in a region that carries a lot of diversities, but we see growth slowing down with an expectation that things will improve next year. Why growth is slowing down? For various reasons. One, the first one is related to the impact of tightening, both in the region and international. Internationally, the tightening and the higher for longer is impacting especially countries who rely on international financial markets for their financing. Regionally, countries also have been tightening in order to address the risk of high inflation. Therefore, this is what triggered part of the slowdown. The other part is the extension of the OPEC Plus agreement that has reduced the volume of production and export, and we had additional voluntary reduction by Saudi. This was the second main reason, and there are some country-specific issues. This is when it comes to the growth. Inflation, we see an improvement. 2023 is a turning point. Inflation is going down, yet we see divergence here. There are countries where they are still with high level of inflation, where additional actions are needed, and there are certain other countries where the measures have already started to produce results. This, of course, has an impact on the overall growth situation. What are the key issues before turning to the main, I would say, risks? Key issues is, one, how to preserve fiscal tightening at a time where inflation is high, how to cope with the higher for longer, and also for countries who have higher level of debt, that needs to find ways to finance their needs over the next few years. What are also the issues for countries who have buffers? Because also those countries have been performing well, and I would like to underscore that when you look at the non-oil sector, you see that the non-oil sector is resilient in a sense that over the last 2 years, the level of non-oil growth is still strong and is projected to remain strong. For those countries, the challenge is how to accelerate diversification, reduce the risk of pro-cyclicality, both diversifying economically and fiscally. What are the risks? Well, the risks until last week were more external. This week, they became overwhelmingly affected by the recent developments. It's very difficult at this stage because things are still unfolding, really to read through. But definitely, there is a huge shift in the matrix of risk. What were the risks until last weekend? One is a slowdown that could affect the region, especially if China or advanced economy. This will affect the oil-producing countries. This is one. The second is the impact of the higher for longer on not only on the access to market, but also on the debt service that constitute now becoming a big chunk of the fiscal spending, and also the capacity to control inflation and to build credibility around that. This week, the situation has moved into much more weight on geopolitical risks than on the other, I would say, global and macroeconomic risks.
Of course, our immediate concern is with the tragic loss of human lives in the region. I guess from an economic standpoint, how do you think about the hit to sentiment?
Well, again, I think, as you said, we are all sad by what happened and sorry for these developments. But it's very difficult to read through economically and financially. Why? Because, again, there are several key questions that we still don't have answers to. If I look at the last 4 or 5 days, what we could see that the first indicator that people look at is oil price. We saw an increase in oil price by $5 in the beginning of the week, but it came down. And still, when I compare the oil price in October to the oil price in September, it's still lower now compared to last month and the months before. On other issues, markets did not move much. But I think, again, I would think that it's very challenging because of the magnitude, the speed, and the unknowns to have a clear reading of the short term or the medium term. But it's an earthquake.
Yeah. Mr. Ahmed, I want to turn to you. Jihad just outlined how he sees some of the challenges facing the region over the next 12 months or so. And of course, it's not a homogeneous region. There are different countries facing different set of issues. But I know that you have looked and covered the Middle East for a very, very long time. How would you describe this episode of the slowdown in growth versus prior episodes? Where do we stand in the context of how stressful the situation is?
Thank you. Well, first of all, I want to say it's wonderful to be back at a Rio launch. I have a history of Rio launches, and it's wonderful to be able to participate in it again. Thank you very much, Jihad, for inviting me. As you say, this is not the first such episode we go through. And I was thinking back 10 years, and that was a moment also when there was a divergence in prospects across the region. But if you compare that period to now, I'd say there are two things that are worse and one which is better. First thing that's worse is that the external environment, the international economic environment, is much less benign than it was. And interest rates have gone up, likely to stay high for a longer time. So all the countries that carry debt suddenly find their bills for paying interest go up. Some of them are spending almost half their revenues on servicing their debt now. That doesn't need much money. Fiscal space gets tighter for them. And also, debt levels have gone up. So what I see is that all the countries that had negative imbalances 10 years ago, by and large, those imbalances are worse now. They're more acute, and their pressures are greater. So that is bad, worse, I think. Second thing is that I don't think that we anticipated at that time that the effect of worsening climate would come so soon. I think we kind of had this in the back of our heads as something that was going to have an impact. But if you look at what's happened in terms of flooding in Pakistan, or if you look at what's happened in terms of agricultural crop production impact in a lot of countries in the region, it's happening now. And it's going to be an added cost for countries to be able to build in the extra resilience to deal with 50-degree summers rather than the 40-degree summers that we used to have. And I think linked to that is the sense of living in a world of shocks. And I think shocks are just going to be much more frequent, more deeper, and affect many more countries now and in the future. I think that's just a big systemic change in the world economy. The good thing that I would say is that I look at a number of, particularly the GCC countries, and if you look at their reforms where they are today, I think in a few of them, they've come along a long way compared to where they were. We used to talk about reform a lot for 20 years, but today you actually see a process of professionalization of services, of the way you manage your resources, the way you manage your wealth, across, and you see that in some countries more than you do in others, but I think that's actually a very good sign that hopefully will spread to other oil exporters as well in the region.
Ahmed, I want to turn to you. The events of the last few days notwithstanding, how is the investment community thinking about the opportunities within the region? And maybe let's just tie it back to what Jihad was saying about this sort of new paradigm that's existing from the Fed, this higher for longer regime, the fact that inflation seems to be on a downward trend. We aren't quite at target for many advanced economies. How does that set the tone, and how does that define how the international community are thinking about investing in Iraq?
Absolutely. First of all, let me also sort of repeat what an honor it is to be invited. Thank you very much, Jihad, for inviting me, and it's a pleasure to be with you, Sir MASOOD, and Monica as well. Listen, I'm going to start my answer by echoing some of the points, and very briefly echoing some of the points that have already been made, but then maybe take a slightly more positive twist to it, a slightly different approach, which to a large extent, and this is how I'm going to conclude, is being mirrored by asset prices, that so far the market reaction to the shocks and new challenges that we've heard about so far has so far been quite benign and quite benign. And I'm going to try to explain why that's the case. I mean, the shocks are very obvious. We know that, right? Real interest rates, the real cost of funding has gone up from minus 100 basis points to roughly 220 basis points. That's a kind of a real shock that happens usually every few decades, not every few years, right? And the level at which the cost of funding is right now is more comparable to where it was back in the 90s than it was over the past 10 years, right? In the meantime, you had a global economy that clearly has peaked, and the deceleration that we've been seeing, benign as it is, and I want to get back to that point, is decently notable, right? I mean, you're seeing it in Europe, you're certainly seeing it in China. China is the one country that does not seem to be able to recover aggressively the way it used to historically, and China does matter for emerging markets. And then on top of it, the third factor is clearly the geopolitical, geostrategic shocks. Now we're focusing on the last weekend. You had the Ukraine war before. These are major issues that create a tailwind, or at least a very inhospitable market conditions for the countries that I tend to traffic in, including the MENA region. The point I wanted to make, though, is that if you were to ask us all, the shocks that I just described are not new shocks. We've known about them for the past 3 years, right? They've been there with us for sort of closer to 2.5 years, right? The outcome, however, has proved to be better than one would have expected at that moment. But the global economy is decelerating, but it's decelerating at a pace that is significantly higher than one would have expected to the kinds of shocks that we just talked about, right? And if you look at it in the forecast revisions by major banks, and you continuously see this pessimism that tends to be followed by upward revision afterwards, right? The global economy, particularly that of the US, is proving to be significantly more resilient, and the call for recessionary risks seem to be continuously postponed. The disinflationary process itself, and you see it in the region as well, is proving to be faster than we expected, but also the nature of the disinflation is proving to be better than we would have expected. It's not just happening from the exogenous, it's happening actually from the demand-driven parts. It's not, Jumana, as you mentioned, we're nowhere close to where we need to be, but it's happening at a pace that is faster and better than we would have expected, right? And the big one, obviously, which is the hiking cycle is almost over, right? That's a huge shift from 2 years ago, where we were in the middle of this massive monetary policy shock. And I think the market has actually noticed that. And you see it both in terms of the valuations, in terms of the risk premia that we're seeing right now. You're seeing in terms of spreads on emerging markets, right? So the market has noticed that the environment, notwithstanding where we're heading, as of today, we're in a better place than we thought we would be, and that's something that the market. The final point I would make, and then I would stop, is that the market is not overly complacent. This notion that things are not that bad, which is in the price in the sense that multiples are high, spreads are tight, it's not across the board. The market has been very good at distinguishing between the strong names and the vulnerable names. The market has been quite resilient to the names, whether they are sovereign or corporates, that deserve to benefit from the better environment that I was describing, but the ones that are closer to the edge, the market is very nervous about.
Well, I guess that ties nicely to what I was going to ask you next, which is about gross financing needs, because we've seen issuance drop in 2022. 2023 has started off slow as well. Given how substantial these gross financing needs are over the next couple of years, as highlighted by JIHAD and MASOOD, where is that financing going to come from? And is there appetite from the international community to buy this paper?
So let me look at the past a bit and try to project it in the future, right? I mean, there's very interesting patterns that are developing in the capital markets. Let's start with the very obvious. Clearly, issuance has collapsed. Not collapsed, has dropped quite sharply, right? And by the way, you're seeing in the MENA, but you're also seeing it, the same issue is seeing it at the global emerging markets, right? At its peak, EM was issuing around $700 billion a year. Today, it's issuing 400, right? This is roughly a 45% drop. You see it in EM, in MENA as well. We peaked at 80 billion. Today, we're at around 30. Right? No question about it. The market are sort of retrenching in terms of how much it lends, and that obviously is an issue because the funding needs, the actual funding needs are large, but also you have the transition financing and the poverty alleviation financing. However, there are a couple of interesting patterns underneath it that I really want to emphasize. The first of which is that most of the decline is, and here I'm going to be slightly technical, and I apologize for this, but it's happening in this thing called in high yield. The riskier names are the ones that are being shot. The vast majority of the contraction that we're seeing in issuance is not happening at the top of the food chain. It's happening at the bottom of the food chain. Right? I want to come back to this point in a second. Right? The second, incredibly, and you're seeing it very clearly in the Middle East. Right? The GCC, Morocco, the countries that have a story to tell have no problem coming to the market.
Yeah.
Right? The countries that are vulnerable are the ones that are having a hard time. Another very interesting pattern and phenomenon. Sovereigns are retrenching, partly because they don't need the financing, partly because their fiscal accounts are in a better place. I'm talking about the GCC. The corporates are stepping up. We're actually seeing a significant increase in strong corporates in the region, right? So these patterns are, and obviously the third thing, which is the price side of the volume, is that spreads on the better quality countries, the higher grade countries, are as close to the tights, as close to the strongs as we've ever seen. So yes, the market is retrenching, but it's retrenching where it should be and being very hospitable and very open to the names that are strong and can access the market, particularly in the corporate sector.
So if I could summarize it, a two-speed MENA. It's two speeds.
I think it's a tale of two MENAs.
Yeah.
A very strong tale of two MENAs.
Yeah. Well, Monica, I'd love to get the banking perspective. So I'm an anchor based in Europe for CNBC, and I was actually covering the whole Credit Suisse collapse in spring this year. And at the time, everyone was so worried about the jitters and what it meant for the whole financial system. But it seems as though, not just within Europe, but the rest of the world have actually been pretty resilient to the turbulence turbulence that we saw in US regional banks and of course in Switzerland. Just give us a sense of how MENA banks are faring and how the banks are also adapting to this new higher for longer environment, and where you see the pockets of risks looking ahead.
Okay. Well, thank you very much for the question, and thank you to the IMF for inviting me. It's a pleasure to be here. So indeed, the MENA banks have been performing very well, both with the changes to capital flows and the higher interest rate environment. A lot of them have very strong capital buffers, and that also supports the outlook. But the macroeconomic developments have also been very positive overall. I sit in the GCC, and that's quite visible. We've seen a number of sectors recover very well from the pandemic, and that reduces the stress on the banking sector. We've seen also the higher oil prices being positive for overall liquidity in the banking sector as well. And that has also meant that despite the fact that GCC economies, other economies in the region also have pegs to the US dollar and have followed the Fed in raising interest rates, we've still seen very strong credit demand. And, you know, compared to what was expected at the beginning of the hiking cycle, actually credit demand has remained far more solid, less of a headwind than we had expected. So these are all very positive developments, so much so that earlier this year the UAE central bank started reversing more of their the pandemic support measures, so increasing the reserve requirement ratios, and you know, the credit demand, where it comes from different areas, reflects the economic environment. So in Saudi Arabia, it's very much being driven by corporates who are driving the investment program. In UAE, again, it's the GREs, and as these countries progress with their medium-term development plans, that's creating demand for credit, particularly from the government-related entities who are key implementers of the project. But in the UAE, also reflecting the reforms, we've seen household credit demand remaining very strong, and that reflects the confidence, the population growth, the fact that more companies in different sectors are moving to the UAE, and those are all very positive indeed. And I think another area of reforms that goes into the points made before about better management, we've seen a number of GREs also having part IPOs, and that has helped to reduce their debt exposure as well. So these are all very positive developments.
Yeah, okay. Jihad, I want to bring it back to oil prices, actually.
Yeah.
We started off when you were giving your overview, and again, we have seen a slight uptick in the price of oil the last few days, but still below where we were. We were almost at $100 a couple of weeks ago. I think that the knee-jerk reaction for many people is to just assume that if there are higher oil prices, that's going to be a good thing for the region. But it is much more nuanced than that. And we know that Saudis have been cutting production. We know that other countries in an elevated oil price environment tend to introduce subsidies. How do you read the impact of higher oil prices as a whole on the region and the region's growth outlook?
I think it has been said already. If we look at the past, we were always pro-cyclical, okay? Especially for the GCC, as well as also other oil-producing countries. This round, starting, I would say, from 2014-15, we saw an acceleration of reform and, let me use a word that you used, professionalization of reform, i.e. it's now being implemented in a medium-term framework and also building the capacity for that. This has helped, A, achieve a certain number of objectives. On the fiscal side, diversify revenue outside oil and build strong frameworks for fiscal management, moving from annual budget to medium term, moving from very untransparent to more information provided. This is one. Two, We see also that structural reform pay. Certain number of labor reforms introduced in Saudi, for example, for women's participation. We saw those in UAE by changing some of the rules. Immediately, the impact was translated into the level of growth. It's interesting to see that in the last 2 or 3 years, the average growth in the GCC non-oil sector is higher than the average growth of the global economy or the advanced economy. Therefore, we are building a new, strong sector that is taking over when oil price goes down. What also we are building is an investment into forward-looking sectors. I see a lot of investment in technology, in climate-related sectors, in order to position the region not only on the service side, logistics, tourism, but also on some of the cutting-edge industrial sectors of the future. But I would, again, there is always a risk of pro-cyclicality and to see a peak in expenditure. There is a need to move from fiscal to, I would say, balance sheet approach, to have those other entities part of the reading of the balance sheet. And 3, recognize that there are certain features that need to be addressed. And let me take 2 very quickly. 1, the volatility. Our region has, in terms of volatility, double, the VIX is double than other EMs. And during the crisis of the beginning of the year in the global financial markets, we didn't see an impact on banks, but we saw an impact on capital flows, including from more advanced markets. Therefore, deepening the capital markets, widening the participation of investors, this is a trend that needs to be developed. Why? Because we saw that the nexus between state and banks growing in the last 2 to 3 years, which may have justified or explained why we didn't see much increase in issuance in the last 2 years. Therefore, I think there is a call to deepen the markets. There is also an opportunity to use the fragmentation that the world is going through with the recent initiatives that the region has elaborated. Building relationship and strengthening with China, with Central Asia and Caucasus, with Africa. Those bridges, I think, will play in favor of growing through the new trade routes, the capacity to create growth and jobs in the region.
Well, the other day, I think it was yesterday, I attended a bit of your panel about structural reforms within the MENA region, and something you said stood out to me. You said you can grow by 2 means. You can do it fiscally, or you can go down the reform path. And in an environment where we talk about higher growth financing needs, higher interest rate environment, I guess the cheaper thing to do is to introduce reforms, but they pay off over the long term. You see it.
I think we confuse 2 things in the region: structural adjustment and structural reforms. I think structural reforms by nature create more space for growth and also more inclusion. They improve access to finance, which means that SMEs, startups will have access to investment. They improve the quality of education, which means access to talent will grow. Therefore, structural reforms are an old thing and not an easy thing. I think one has to recognize the political economy of reforms is very challenging.
Yep.
But it's still much better and much more sustainable than other ways. And we saw it in the Gulf. They have the financial capacity to respond very quickly through high sugar measures by easing the fiscal. I think they decided that no, there is maybe a better way that takes more time, but it's more effective over time.
Masood, would you like to weigh in on what you think should be the key policy reforms that the region should be focusing on right now?
Well, I just to underline what Jihad said, that look, I think we've known for a long, long time what are the kinds of reforms that would help to unleash a higher trajectory for growth going forward. And first of all, you've got to get your fiscal in order, because in many of our countries now, I think the deficit numbers are rising rather than falling. But then you've got to look at labor markets, governance. There's a whole, and there's a very nice chapter, by the way, in the Rio that covers those reforms. But the problem that I see is that there is a set of, I'm sorry about there's an echo on this, but there is a set of countries where quite a lot of people live in the region. I would say actually the majority of people live in those countries in the region who have difficulty getting their act together to undertake those structural reforms over time. And as a result, they are the ones, when AMER's numbers drop from 80 billion to 30, they're the ones that get frozen out of the market. Absolutely. But they're also the ones that have the high debt. They're also the ones who are having difficulty making their payments on a regular basis. And they sit on a very difficult edge. Their political and social prospects problems are also quite severe in many cases. So you have this group of countries in the region, and then some of them actually are in conflict. I mean, look at Sudan, and then you see what happens. But for a moment, I'm not talking about the ones that are in conflict. And I think this set of countries needs to find a way to get on the path where they can mobilize the consensus to do the difficult reforms, because they are difficult, and to have the support to be able to see them through that phase so that they can get onto a higher trajectory. And to me, that's what I really worry about in the region. I think the GCC countries are doing the reforms and also have the financial wherewithal to see their way through it. I think the conflict countries have to deal with a set of issues which are quite, sort of in some ways, tragic, but they're not really economic reform issues so much. But there is a set of countries that sits in the middle, and it's not a trivial set of countries. You know, it's large enough that I think we need to worry about them.
Ahmed, let me just ask you, I mean, you touched on this a little bit earlier with your first answer about how the international community viewed the bond market, and essentially you've got the more solid issuers, and then you've got what you called the high yield. Assuming that we are talking about that basket of high-yield issuers where some of the structural issues are deeper, more perplexing, more challenging, will the investment community reward them for doing the right thing? Do you see a passageway to go away from, you know, being high-yield and in that basket towards moving up the chain?
I mean, the good news is I think there's enough history in the last 40 years since the emerging market started, where yes, I mean, what we call rising stars, shooting stars, upgrade sovereigns and corporates tend to have easier access with a cheaper pricing, a cheaper yield. I think the answer is absolutely yes. But I sort of wanted to, again, it's a fascinating panel because I think it's a very important line that is, I think, undercurrent that is coming from everybody here, which is that, and I'm going to spend more time on the high yield because I think that's your question. But I really want to emphasize this idea that the gap between the strong and the weak in the region is as big as it's ever been in my experience, right? The strong is doing the right thing, right? You see it both, and I'm here, I apologize for repeating, right? Their trend growth is rising, right? Not just growth cyclically, trend growth, potential growth is, and I'm sort of, the fund has done very good work on this one. They're doing it in a more fiscally responsible way, right? The resilience of the non-oil sector. And it's all based, and it's all predicated on a true, I mean, there are risks, right? Falling back into procyclicality is always a risk. But for the time being, they're doing it predicated on a strong structural side and being helped, we didn't mention it yet, by a great demography. But this is a young population with a very low participation rate by a very dynamic group, women, right? This story is an exciting story. Like, I want to emphasize this. This is an exciting story. This is not your traditional boom bust that we've seen in the past in the oil exporting countries, where oil prices are high, they do well, oil prices are low. This one feels very different. Sadly, they're leaving the rest of the region aside. And that gap keeps on rising. And here, in a sense, I'm echoing what Sir MASOOD was talking about, which is that this is where the demographic concentration is in the, let's be clear, like Egypt and the Tunisias and the Lebanons and the Syrias of the world. This is where the vulnerability is. And sort of I spend a lot of my time thinking about, can they get out? And the answer is yes, they can. But at this stage, there is a two-step process. It's no longer easy anymore. Today you have a stock problem.
Yeah.
They've postponed the solution so long,
Yeah.
right? The problem has been postponed for so long that there's a legacy of indebtedness that is becoming an overhang. Right? Even if they do everything else right, the second stage, the reform side, today you have a problem of funding needs that has come as a result of years and years of living beyond your means and not putting your resources in the part of the economy that is actually profitable, that allows you to pay back that debt. You end up with a story where you kick the can, build up the debt, and now your productive economy cannot pay for that debt. And now enters what Masood was talking about, the difficult reforms. So the difficult reforms that are needed in order to generate the resources to pay for the past debt, politically difficult as they are, the challenge is much bigger because the starting point is significantly worse. I don't want to be overly pessimistic,
Yeah.
but sadly, the stock is a problem, and then you have the historic traditional flow problem of how do you deal with it.
Yeah. Monica, I was going to ask you a question about the banking system, but I know that you're, an economist as well, and if you would like to weigh in also on what the gentlemen were just talking about vis-a-vis that distinction that's emerging between, say, the richer countries within the region and those that have a lot more financing difficulties.
Absolutely, and just as a background, I've been looking at the Gulf economies for over 30 years, so I very much agree that this time it's very much different, and it's the levels and the fact that the reforms continue to build. So, for example, even though oil prices are high, we still see the UAE introducing corporate income tax. It's a point where they don't need to. We still expect to see strong fiscal surpluses. There are some signs, though, for example, in Saudi Arabia, that the government is increasing spending. We've seen that in the pre-budget statement, and compared to 2 years ago, it's a significant increase. So again, that sort of raises some need to keep oil prices high, but the fact that the region has also been reducing debt levels and building up fixed income buffers that allow for small deficits to be able to continue. Oman also has been reducing its debt levels very much so. So these are all very, very positive developments. And I agree that, with the other non-GCC countries, a lot of the reforms, it's not only harder because of the size of the problem, but the social impact is, of course, going to be significant. It's also at a time that, we're moving away from the economy that we've been used to from the post-global crisis. That was a time of low interest rates in developed economies, and countries could just, have a higher real interest rate, and there would be a lot of capital flows. And I think now the reforms have to be done in a global environment that you are not going to see these. You're not going to see these capital flows coming back, just playing on the carry trade story. So that makes it very much harder as well. Egypt, very large net foreign liability position, and that reflects the shortage of dollars. And what the market really needs to see is medium-term reforms to become confident to see either FDI or portfolio flows, and for that a currency exchange rate that is viewed as being sort of fairly valued is essential as well. And of course, we've seen inflation picking up as a result of the devaluation, higher nominal interest rates, but we've got to a point where these reforms have to be done.
I just want to round up the discussion. Maybe just a final point on the potential for inflationary shocks, and food insecurity is a big theme in the region as well. And actually, if you look at the trend of food prices are still higher than they were pre-pandemic. What would your recommendation be to countries to become more resilient to food shocks specifically? We spoke about oil. We did not speak about food.
Well, the quick answer to your question is have the monetary policy address the inflation issues. It's more complex than that because you need to complement it with an updated social spending policy that targets better. And again, redistribute the resources to the people who need it most. When you still have a way of distribution through the subsidy on fuel, you're definitely not doing the right thing of very limited resources you have. Therefore, one is use the monetary policy, do widen and improve the quality of your social protection framework. 3, give perspective over the medium term. And I would like to add a drop of optimism to what has been said. Taking 3 examples, Jordan, Egypt, and Morocco. Jordan, we had been struggling, and MASOOD was at the time in charge, struggling moving with the reforms, and we had several programs. At some point in time, we had, been able, especially with the latest program, we have been able to move forward and go through successive shocks that have allowed Jordan to be resilient. Second, Egypt. Egypt has done important reform back to the program in 2016, and we saw the market responding very quickly. Again, I want to say that yes, maybe the journey is long, but I think immediately when you start doing things, the positive momentum will build up. Again, I still remember rates of growth in Egypt of 5.5%, 6% despite COVID. Therefore, again, I think what we need to give is, maybe was one, Monica said, direction, and to have the resolve to go beyond the first step. Morocco also, it's a story that is different. It's a story of, long-term steps that took 10 years or more, but also because their governance system is different. Therefore, I don't think that there is one solution, but again, is not to be discouraged, and markets will respond usually faster to positive news. Therefore, I have hope.
That's a good place to end it, actually. Okay, we're going to open up to Q&A. If anyone has any questions, please put up your hand. Gentleman at the front.
Thank you, Chair. I am Mohammed bin Madani. I'm a journalist, a scholar, and the editor of the Maghreb Review, published in London. My question is very simple. After COVID-19, more people become richer and richer, and more people become poorer and poorer. So what's your views? If I have my chance for one small question, even in the entire North Africa, because that is my field, and I teach it. I know North Africa, people are becoming more and more poor, older and older, and the establishment are not putting anything aside for the older people. In my opinion, you are completely out of touch. I spent last Saturday and Sunday traveling the entire Marrakesh and public buses, and I know what people think and feel. I don't think any of you do.
Well,
so that's my question.
I think the question is more to do with some of the structural challenges facing the region. You talk about, widening inequality and higher, and the demographics not working to the advantage.
I think you are raising an important issue, and especially by raising the question from the angle of the COVID-19. What COVID-19 told us, and we did recently a study on that, on the informal sector, told us a few interesting things. In the past, when you used to have a big shock, what was the first buffer was the informal sector. In the COVID-19 crisis, because of the nature of the shock, the informal sector did not play the role of the buffer, and highlighted certain number of issues that need to be addressed. Access to technology played a big factor in deviating or on creating a bit two-tail. Access to services. Therefore, yes, the COVID-19 crisis impact was maybe more severe than previous crises, and informality did not help. The second thing that we saw, that the social protection system worked differently in different countries. And again, on a positive side, it helped accelerate some of the mechanisms. For example, using electronic means for cash transfer was widely used in Tunisia, used in Morocco, but also take the case of Egypt. Because they had the Takaful and Karama program, they were able immediately to scale it up. Therefore, which told us that those reforms need to be expanded, and targeting better and providing the right channel of response and responding quickly is very important. 3, again, I go back to my original point, is when your resources are limited, you have to be smart in distributing them.
Absolutely.
You don't give your resources to those who don't need it.
Yeah.
Give it to those who need it. This region spends 2.5% on social protection. In certain countries, the spending on the public wage bill exceeds 16%, 17%. Is it right for those who have no social protection not to be supported by the state? And last point, which I want to conclude with that, you're right, inflation is affecting the retirees because the pension system is not rightly designed in order to protect the vulnerable. Therefore, I think what we have ahead of us are important reforms that we need to conduct and expect, like the trees, the olive trees that we have here. You need 7 years before planting a tree, an olive tree, and to see the first result. But trees of all, olive trees could last centuries. Therefore, it's important to take the time you need in order to build the infrastructure for better policies.
All right, another question?
Hi. Hello? Can you hear me?
Yes.
Ala Shaheen from SRMG. A big caveat in the exciting Gulf diversification story is what we all refer to as the cyclicality, and everyone was talking about, this is an exciting story, but yes, true, we're still affected by cyclicality, but so are we at least getting close to breaking that cycle in the Gulf? Because that's been the key element in previous attempts. Oil prices are high, you recycle that into current spending, into capital spending, oil prices collapse, and that journey ends. The second bit on the oil importers in the region, and a lot of the talk about the subsidy reform, and we get the logic. In how to address it, the key focus becomes on addressing the most vulnerable communities, increasing Takaful and Karama in Egypt for now. But we haven't heard so far an argument into how to protect the middle class, which has been shrinking in those countries, and where you see the resentment and the resistance that is coming to IMF programs and others. Thank you very much.
Let me sort of take a stab at the first question, because I think it's an extremely interesting question. I mean, it's a judgment call, right? But I think that linkage between trend growth and cyclicality has maybe not broken, but has certainly weakened, and that's a positive. That's a good thing. And why do I say that? I say that because I think trend growth has gone up, and the idea of trend growth is the one that is, by definition, unrelated to the cyclicality. I think there's enough structural reforms that have happened that I feel comfortable that the region as a whole can grow at least 1.5% above where it did in the past, independent and irrespective of it. This is the trend. It doesn't mean that occasionally you're going to go through ups and downs. 2, it seems to be significantly, not significantly, sort of factually, for the time being, there's always a risk of reversals. The non-oil part of the economy seems significantly more vibrant and less sensitive to oil prices than I've seen in the past. The non-oil sector seems to be doing well structurally by itself, right? And you see it also in the fiscal accounts. the gap between oil revenues and non-oil spending, right, has shrunk quite a bit, like, by percentage points of GDP, 10, 30% in Saudi Arabia's case, right? 3, so the contribution of growth that is happening right now is coming from is predominantly coming from the non-oil sector, from the private sector, right? To be perfectly fair, the investment side of the story is completely still public sector driven. There's no question about it. Of that 1.7 trillion that is being talked about, the vast majority of it is coming from the public sector. Right? We haven't yet seen the private sector step up and take over the investment, right? So I feel comfortable that in sort of making the statement that cyclically we seem to be less sensitive to oil prices than we were before, but the big test will be, now that we've built it, can they come? Will the private sector come? This is more the balance sheet story, where I don't think we're there yet. I don't know, I'm
going to say we have time for just one more question. I know Mr. Masood has to leave. I don't know if you want to tackle the question about subsidies, and then...
If you don't mind, I would, because I just want to come back to the question you raised. I think you're pointing to a very important and difficult issue, because when you look at it from the point of view of a technical analyst, if you sit in the international institutions or you sit in some sort of research institute, you obviously say, well, let's protect the most vulnerable. But if you're a political leader, the people you need to worry about also are the middle class in urban areas, not necessarily the poorest, who are actually the ones that are going to come out on the streets when you raise electricity prices or when you raise fuel prices. And finding the right balance on how far you extend your safety net to cover not just the poorest, but still be affordable, is the matter of political judgment. And I think on that, my feeling is that it is the leaders of the countries that are best placed to make that judgment call, but the role of the people questioning the system is to make sure that under the guise of protecting the middle class, you're actually not protecting the connected class, because really the benefits go a lot to the connected classes rather than to the middle class. But I think what you're raising is a very difficult but very real issue that has to be tackled to make the reform happen rather than just design it theoretically.
Thank you. I'm with the Dubai International Financial Center. One of the terms I haven't heard today is on productivity. And so is it the case that when you talk about reforms, it's embedded in there? Or how do you think about productivity as a key driver in long-term resilience and growth? It's something that the IFC and obviously UAE has spent a fair amount of time looking into.
Maybe because you didn't give you enough the floor, and I will come back on this.
Okay, I think that's going to be one of the key challenges for the wider MENA region, especially in attracting FDI. We have seen, especially in the UAE, where I'm also based, a lot of focus on that. But again, going back to the issue of bringing in private sector, bringing in greenfield investment, and again, UAE and Dubai has done very well for that. And we've seen various labor reforms to make it easier to bring in companies, labor force, etc. But also a key challenge is creating the jobs for the youth population, whether it's the GCC or the wider region. But I think sort of, again, and this goes hand in hand with the fiscal position, how much money is being spent on debt, just servicing the debt. But you need to get to a point where more is going towards areas such as educational reform to make sure the output of the labor market is meets the requirements, increasing productivity. New sectors are continuing to grow, more technology, and other emerging markets, maybe the labor force is more in tune. So I think this is also where the macro and micro fit in and is essential for bringing in FDI by new technologies, new labor market developments?
That labor productivity, all the analysis are showing that is not progressing enough. And this is why you have chronically higher level of unemployment than other parts of the world. Therefore, yes, there is a need to improve productivity, improve labor productivity in particular. The future of work could even destabilize further that issue. Linking it to Ala's question and only adding a footnote, also, you should keep an eye when it comes to the middle class on the public services, because big chunk of the increase in their cost of living is becoming because of weak public services governance issues. Therefore, things are linked, and with the change in the way we behave and we consume, I think it's very important from a policy making perspective to look beyond the basic lever that we usually use in development economics. Therefore, I think it's an important issue. It's definitely a key issue, but it requires to also go beyond the fiscal lever. And this is why part of what we are trying to show that structural reforms can help you in that. Structural reforms can work when you have high growth or when can you have low growth, and the combination is different.
Well, that's a good place to leave it. Panelists, thank you so much. A very enjoyable discussion, and thank you all for attending our discussion today.